You know that feeling, right? You get a raise, you feel great for a minute, and then you look at your bank account a few months later and wonder, wait, where did all that extra money even go? You're working harder than ever, your salary's climbing, but you just feel stuck. Well, let's get into it. Let's really unpack this paradox and figure out why working hard isn't making so many of us wealthy. And boom, there it is. This quote just hits the nail on the head. This is the whole theme of what we're talking about today. It's not really about how much you earn, it's about what you do with it. And that difference, honestly, can be just a handful of smart choices. So, to really get this, let's meet someone who might feel, well, pretty familiar. We're going to follow the story of a guy named Mr. Tulwar. Now, he's not a real person, but his story, man, it's a mirror image for millions of middle class families out there. So who is this guy, Mr. Talwar? Well, he checks all the boxes, right? He's educated, works hard, has a good, stable job. He's a responsible family guy, paying his EMIs and insurance premiums, and, like so many of our parents and grandparents, he absolutely believes that property is the safest investment you can make, and he's pretty skeptical about the stock market. But here's the kicker. Even though his income has been going up for years, his savings just aren't. Sound familiar at all? Now, Mr. Talwar's situation isn't really his fault. See, he's caught in a few unseen financial traps. I like to call these the silent wealth killers, because they're working against you in the background, and you might not even realize it. The first one, and honestly, maybe the biggest one, is lifestyle inflation. It's just human nature. You get a raise and you think, you know what, I've earned this. I'm getting a nicer car or a bigger TV or fancier vacation. And you do deserve it. But this habit is an absolute killer for building wealth. Your expenses just creep up right along with your income, and you end up running in the same place. So where is all that extra cash going? Well, look at this. A massive 50% gets completely eaten up by those lifestyle upgrades. Another big chunk goes to new EMIs for those new things, and what's left over for actual savings? A tiny little 10%. See? This is exactly how a pay raise can vanish into thin air without making you one bit wealthier. And if that wasn't bad enough, here's the other side of the story. It's not just about what you're spending, it's about what things actually cost. Your salary might be growing by, say, 7% a year. But the real costs, things you can't avoid, like healthcare and your kids' education, those are going up by a staggering 12%. That gap you see right there? That's the financial pressure cooker. That's why it feels like you're running as fast as you can, but the finish line just keeps getting further away. All right, let's talk about the next trap. And this one is a biggie. It's an idea so baked into our culture that even questioning it feels kind of wrong. We are talking about the obsession with real estate. You've heard it a million times, right? From your parents, your grandparents. Buy land. They're not making any more of it. It's sold to us as the safest, most reliable way to get rich. But what if? What if that single belief is the biggest thing holding you back? Okay, let's just bust this myth wide open. First off, property is illiquid. You can't just sell a bedroom when you need cash fast. It also locks up a huge chunk of your life savings in one single thing. The transaction costs, like stamp duty and registration, are enormous. And the real returns? They often don't even beat inflation anymore. Oh, and the rent you'd get from it? A tiny 2 to 3% a year. It's just not the golden ticket it's cracked up to be. And this is the point I really want you to take away. For most of us, like Mr. Talwar, pouring every last penny into a massive EMI for a house doesn't build wealth. It actually strangles the very cash flow you could have used to build real, diversified wealth somewhere else. Okay, so we've talked about spending habits, we've talked about investments, but the real root of this whole problem, it goes deeper. It's all about your mindset. It's about the fundamental difference between a salary mindset and a wealth mindset. This chart just lays it out perfectly. The salary mindset thinks stability is everything and is totally dependent on an employer. The wealth mindset, it understands that true security actually comes from growth, from owning quality assets that are working for you 24/7. It's not about being terrified of losing your job. It's about building a financial machine where your job is just one gear, not the whole engine. And this right here, this is the diagnosis for the whole problem. It's not that people don't earn enough money. The real failure is putting the money they do have in all the wrong places. Way too much in low-return assets like real estate, not nearly enough in high-growth things like equities, and just letting lifestyle inflation gobble up the rest. Okay, so that was a lot of doom and gloom, I know. But here's the good news. There is absolutely a way out of this trap. There is a clear path forward. It's just about breaking some of those old, unhelpful patterns and building a new system. And here it is, a simple 4-step framework. 1. Get a handle on that lifestyle inflation. 2. Stop putting all your eggs in the real estate basket. 3, and this one is so important, start increasing your exposure to equities. But you got to do it the right way. And 4, change your focus to the most powerful force in the financial universe, long-term compounding. So what does the right way even mean? Well, there's this amazing philosophy called coffee can investing. The idea is just beautiful in its simplicity. You buy a portfolio of really high-quality companies, businesses with amazing brands that just keep growing, and then you do nothing. You metaphorically lock them in a coffee can, stick them in the attic, and don't touch them for 10 years or more. You just ignore all the daily market drama and let compounding work its magic. It's about patience, not trying to predict the future. And that leaves us with this one last, kind of provocative thought. We live in a world that is constantly yelling at us to do more, trade faster, chase the next hot thing. But what if the smartest, most powerful financial move you could ever make is to choose well and then simply do nothing at all? What if the path to real wealth isn't about being more active, but about being more patient? Hey everyone, and welcome. Today, we're going to break down a really powerful, but also surprisingly simple investing strategy. It's built for the long game, it's called the coffee can philosophy, and honestly, it might just change the way you think about building wealth for good. So, let's just jump right in with a big question. We're all looking for that secret formula, right? That hidden edge. But what if the most powerful tool in the entire market isn't about being smarter or faster, but just about being more patient than everybody else? Just keep that idea in the back of your mind as we go through this. So, where did this whole idea get its name? Well, it all goes back to a story, a forgotten secret that was uncovered by a legendary investment manager named Robert Kirby. And what he found out pretty much caught him completely by surprise. Okay, so the story goes like this. Kirby was meeting with the widow of one of his clients, a guy he'd been working with for years and years. Kirby had been giving him stock tips, guiding his picks, managing his portfolio just like any other client. But as Kirby started digging through the portfolio's history, he noticed something really weird. The husband had followed every single one of Kirby's buy recommendations right down to the letter. But he'd completely ignored every single sell recommendation. He just bought the stocks and then did nothing. And the result? It was absolutely staggering. This portfolio, which was basically forgotten, like the old days when people would hide valuables in a coffee can and stick it under the bed, it had completely crushed the performance of his other actively managed accounts. The simple act of doing nothing had created incredible wealth. You see, Kirby's discovery really shines a light on a fundamental truth about investing. A lot of the time, the biggest risk to your money isn't a market crash. It's the person you see in the mirror. We are, so often, our own worst enemy. And that kind of begs the question, right? If doing nothing can be so ridiculously powerful, what are all the things that we do that end up wrecking our returns? Well, it pretty much all comes down to our own behavior. I mean, take a look at this list. It probably feels pretty familiar, doesn't it? We're just hardwired to act, to chase the hot new trend, to panic when the news looks grim, to constantly tinker. The whole point of the coffee can philosophy is to fight against these exact instincts. And that brings us to the solution. It's an elegant, simple framework designed specifically to stop these bad habits in their tracks and instead harness the incredible power of just being patient. So here it is in a nutshell. You find a handful of truly outstanding businesses, you put them into your portfolio, and then, metaphorically of course, you seal that coffee can shut. You make a deal with yourself, not to touch it, not to sell anything, not to second guess it, for at least 10 years. The idea is to let these great companies do all the heavy lifting for you. It all really stands on 3 simple pillars. First, an absolutely ruthless focus on quality. Second, harnessing the superpower of patience. And third, a deep commitment to simplicity, which means you trust the businesses you own instead of getting spooked by all the market noise. Okay, so that sounds great in theory, but how do we actually find these so-called outstanding companies? Well, this isn't about gut feelings or listening to a hot tip. It's about using a really strict, data-driven filter to separate the good from the truly, truly great. And at the very heart of that filter is one key number: return on capital employed, or ROCE for short. Now, think about it like this. If a company is a money-making machine, ROCE tells you exactly how good that machine is. For every single dollar you put into the machine, how many dollars of profit does it spit out? It is the ultimate measure of a quality business. Now, this right here is the gatekeeper for the coffee can portfolio. To even be considered, a company has to have grown its sales by at least 10% and achieved an ROCE of at least 15%. And not just for 1 year, no. It has to have done that every single year for the last 10 years in a row. This is an incredibly high bar to clear. So out of the thousands of companies on the market, how many do you think actually pass this incredibly strict test? Well, in the Indian market, where this was tested extensively, the number is usually just 10 to 15. That's it. This just goes to show you how rare true consistent quality really is. So once you've found these rare gems, the hardest part of the entire process begins: doing absolutely nothing. And this is where the magic happens, because your inaction unleashes two of the most powerful forces in all of finance. The first superpower is what's called a competitive moat. Basically, these companies have a huge, durable advantage, like a brand that everyone loves or a scale that no one can compete with, that protects them, just like a moat protects a castle. And that protection, that stability, is what allows the second superpower to work its magic: uninterrupted compounding. Let's actually see what that looks like, because the numbers are pretty mind-blowing. Let's say you invest £100,000 in one of these businesses and it grows at 20% a year. After 10 years, you've got over £600,000. Pretty amazing, right? But believe it or not, this is where most people get off the ride and sell. But look what happens if you just stay put. If you let that same investment ride for another 10 years, for a total of 20, it doesn't just double. No way. It explodes to over £3.8 million. The growth you see in that second decade is 5 times bigger than the growth in the entire first decade. And what if you can just hold on for 5 more years after that? A total of 25 years. Well, that initial 100 grand becomes almost 9.5 million. This is the exponential magic that our own impatience completely destroys. And this really gets us to the core message of this whole philosophy. Your biggest advantage as an investor isn't how smart you are or how much you know. It's all about your behavior. This table just lays it out perfectly. You have a choice. You can be the active investor on the left, always stressed, chasing fads, reacting to every bit of news. Or you can be the coffee can investor on the right, someone who trusts quality, ignores all the noise, and lets time become their single greatest ally. It's a choice between chaos and a kind of financial calmness. It all just boils down to this simple, beautiful formula. You find a high-quality business, you add a long holding period, and then you add the secret sauce: zero interference. The result, over time, is massive wealth creation. It's that simple. So, I'll just leave you with this one last thought to chew on. We spend so much of our energy trying to know more, to analyze more, to predict the future. But what if we shifted that focus inward? What could you really, truly achieve if you decided that your greatest competitive advantage wasn't your knowledge, but your own discipline? All right, today we're going to dig into a really simple but incredibly powerful idea. It's the secret behind some of the greatest investment stories in history: why the absolute biggest opportunities are very often found in the smallest companies. So you want to know the secret, the real secret to finding those investments that can generate truly life-changing wealth over the long haul? Well, here's a hint. The answer probably isn't where most people are looking. It's not in those massive household name companies that are all over the news. Sure, they're stable, but explosive? Rarely. Nope, the real magic, the real opportunity is hiding in today's small companies, the ones that are destined to become the giants of tomorrow. But to find them, we first have to understand where they hide. Seriously, think about it for a second. Every single massive, iconic company that you can name today started out small. They were often overlooked, just quietly building up their strength before anyone else really noticed. And see, these smaller companies have this kind of built-in advantage. They can totally dominate a small niche market. They're nimble, they can innovate quickly, and most importantly, they have these huge runways for growth ahead of them. This lets them grab market share way faster than a corporate giant ever could. Okay, and this is really important, let's be crystal clear. We're not talking about just any small company. That's just gambling. The key, the absolute key, is this powerful combination. Small size plus impeccable quality. When you get those two together, that's a true wealth compounding machine. So how does this actually turn into those huge returns we're all after? Well, it all comes down to some very simple but incredibly powerful math. All right, check this out. We've got two companies here. Now, on the surface, it looks like the big firm is the winner, right? It added 2,000 crore in revenue. The small one only added 50 crore. But that's not the whole story, not even close. And this is where you see that scalability superpower kick in. In percentage terms, that small firm grew by a massive 50%. The giant, only 20%. Now imagine compounding that higher growth rate year after year after year. The results can be absolutely mind-blowing. Okay, so we get the why. That's the easy part. The million-dollar question is, how do you actually spot one of these future giants while they still look, totally ordinary to everyone else? The very first thing on your checklist should be something called an emerging moat. Think of it like a company's secret weapon. It's this hidden advantage that might not be obvious to the market yet, but it's what's going to allow them to defend their turf and grow like crazy in the future. So what does that even look like in the wild? Well, it could be a bunch of things. Maybe they're the undisputed king of a tiny, overlooked niche that nobody else cares about. Or maybe it's a company that has a certain region completely locked down, perfecting their business model before they go national. It could even be a brand that has fanatically loyal customers, or a management team with just exceptional integrity. People you can actually trust to do the right thing for the long run. And here's the second piece of the puzzle, and honestly, it might be the most important one. It's disciplined capital allocation. I mean, growth is great, but if a company just wastes all the money it makes, what's the point? The truly great companies are masters at taking their profits and reinvesting them into things that will make them even more money. And there's actually a number you can look for here. A quality small company that can consistently generate a return on capital employed, or ROCE, of 15 to 20%, that's a huge green flag. It's basically telling you that it's a phenomenal wealth compounder. In plain English, it just means they're ridiculously good at turning one rupee into more rupees. And look, this isn't just some textbook theory. You can see this exact playbook in action with some of the biggest names out there. Asian Paints? It started as a tiny regional paint supplier. Titan was just a simple watchmaker before it brilliantly expanded into jewelry. And Page Industries? They built an absolute fortress of brand loyalty around Jockey. They all followed the same path. Start small, skill with discipline, and eventually dominate. Okay, so you might be thinking, if this strategy is so powerful, why isn't every single person doing it? And that's a great question. The answer comes down to a huge misunderstanding of one key idea. So why do most people miss out? It's usually a few things. First off, there's this deep-seated bias that just screams small equals risky. People get spooked by the price swings. Plus, you've got the herd mentality, with everyone just chasing the same big, famous names. Because these smaller companies, they get almost zero media coverage. They're flying completely under the radar. So this is probably the single most important mental shift you have to make. You have to separate these two ideas. Volatility, that's just the stock price bouncing around day to day. It's temporary. It's just noise. But risk is the real monster under the bed. That's the chance you could permanently lose your money. A great business can be volatile, but that doesn't mean it's truly risky over the long term. And that brings us right to the final and most essential part of all this. It's the mindset you have to adopt if you want to successfully find and, just as importantly, hold on to these future giants. But look, to find the diamonds, you got to be an expert at spotting the fakes. You have to be on the lookout for some major red flags. Is the management team weak? Is the company just drowning in debt? Are they just recklessly expanding into businesses they know nothing about? Your mantra has to be always quality first. When you boil it all down, it comes back to this one really elegant idea. Small companies are the engine for growth. High-quality companies are what give you endurance. And when you find a business that has both, that's when you unlock the magic of extraordinary compounding. So, the giants of the next decade? They're already out there right now, operating quietly, building their defenses, and just waiting to be discovered. The only real question is, are you looking in the right places? All right, today we are diving into an investing strategy that's all about one thing: protecting you from your single biggest financial enemy, which is, you guessed it, yourself. It's called the coffee can portfolio, and it is a radically simple idea that might just completely change how you think about building wealth for the long run. So let's just kick things off with a big question. We're constantly told that being a great investor means more research, more trading, more decisions. But what if that's all wrong? What if it's actually holding you back? I mean, what if the real secret was to just find a handful of truly incredible businesses and then do absolutely nothing for a decade or even longer? That is the powerful and frankly pretty counterintuitive idea we're going to break down right now. Okay, so to really get why this strategy works, we first have to talk about the problem it's designed to solve. And as it turns out, the biggest roadblock to our own investment success is often staring right back at us in the mirror. Just think about it for a second. Have your own actions, your own decisions, ever cost you money in the market? I think for most of us, if we're being really honest with ourselves, the answer is a big fat yes. We are just wired to make these classic mistakes. We trade way too much, and all that does is rack up fees. We chase the latest hot trend right before it crashes and burns. We panic during a market dip and sell at the absolute bottom, locking in our losses. And maybe the worst one of all, we sell our big winners way too early, completely cutting off the magic of long-term compounding. These aren't analytical mistakes, they're behavioral errors, driven by emotion and noise. And that is the exact problem the coffee can portfolio was built to fix. It is a system specifically designed to take our own worst instincts completely out of the equation. So, what is it? Well, the idea is so simple. It's beautiful. The name actually comes from the Old West, back when people would stick their valuables, like actual stock certificates, inside a coffee can and hide it away. The modern version is this. You find a portfolio of truly exceptional companies, you buy their stock, and then you metaphorically lock it away in that can and forget you even own it for at least 10 years. No tinkering, no trading, no second guessing. And the whole purpose here is so important to grasp. This is not about being a stock pitching genius. It's not about predicting the next market move. It's about creating a system that forces you to make fewer decisions, to stop trying to predict the future, and to just let the incredible power of compounding in great businesses do all the heavy lifting for you, completely free from your own emotional interference. Okay, so this is where the theory gets real. How do we actually find these so-called great businesses? Well, the whole strategy hinges on two incredibly strict, totally unbreakable rules. Okay, rule number one, the company must have grown its sales by at least 10% every single year for the last decade. No exceptions. That proves there's consistent demand for what they sell. Rule number two, its return on capital employed, or ROCE, has to be over 15%, again, every year for 10 straight years. Now, ROC is just a fancy way of measuring how good a company is at turning money into more money. A high ROC is the signature of a fantastic business with a real lasting advantage. And let me be clear, that 10-year requirement, it is absolutely non-negotiable. Why? Because a couple of good years can just be luck, you know? Anybody can look good in a hot market. But a full decade of consistent high performance, that proves true quality. That shows a company is resilient. Look, the whole point of these filters is that they're designed to be incredibly tough. They are going to eliminate something like 98% of all the stocks out there, leaving you with this tiny, elite group of companies that have proven their excellence through thick and thin, through multiple economic cycles. So, once these super strict filters give you that short list of elite companies, the next step is actually putting the portfolio together. The ideal size is somewhere between 10 and 15 companies. If you have any fewer, you're a little too concentrated if one goes wrong. Any more, and you start to water down the impact of your biggest winners. So 10 to 15, that's the sweet spot between focus and diversification. So how do you decide how much to put in each stock? Well, the answer is kind of my favorite part. You don't decide at all. You just take your total investment and divide it into 10 or 15 equal chunks. This equal weighting approach is so powerful because it keeps the whole thing mechanical. It removes your own biases and stops you from playing favorites. And one of the most interesting things that happens when you follow this process is that you get great diversification automatically. Because so few companies can actually pass these tests, Your final list will almost certainly be spread across a bunch of different industries. You don't even have to think about diversification. The system just hands it to you. Okay, so you've found your elite companies. You've invested your money. Now comes the part that sounds like it should be the easiest, but in reality, it is, without a doubt, the single hardest challenge for any investor.
And this quote really says it all, doesn't it? The success of this entire thing, it all comes down to your ability to follow one simple but psychologically brutal rule.
We call it the zero interference rule. For 10 years, you do not touch this portfolio. That means no selling a stock just because it's gone up a lot, no rebalancing your positions, and absolutely no selling when the market eventually has a meltdown. You are committing to complete and total inaction. And of course, I know what you're thinking, but what about a market crash? What about a recession? Or the next global crisis? Every single instinct in your body will be screaming at you to do something. The answer is always the same: do nothing. Just remember the filters. These companies were specifically chosen because they have a 10-year track record of not just surviving, but thriving through crises just like these. They are built for this. Your only job is to get out of the way and let them work. All right, let's wrap this all up. Here is the simple blueprint for putting this entire concept into action. It's really just 6 steps. 1, get 10 years of financial data. 2, apply those 2 strict filters for sales growth and ROCE. 3, from the list of companies that pass, pick 10 to 15 of them. 4, divide your capital up equally among them. 5, make the investments and then put the account details somewhere you won't be tempted to look at them. And 6, the most important step of all, make a firm commitment to not touch it for a full decade. Let's end on this one last thought, which I think just perfectly captures the whole philosophy. The coffee can strategy isn't about being smarter than the market. It's about having the wisdom to identify genuinely great businesses and then having the discipline and the patience to simply let them do their thing. That's all for this explainer.
All right, let's dive in. Today, we're talking about designing your financial life. And I mean really designing it, not just managing money day to day. We're going to build a system, a blueprint for long-term wealth and, more importantly, for freedom. This goes way beyond just picking a few stocks. Let's get started.
So let's start with a question that, probably hits close to home for a lot of us. It's this weird paradox, right? You work hard, you get a good job, your income starts to climb, but you look around and feel like you're just treading water. The numbers on your paycheck look good, but that feeling of real wealth, of true security, it just never seems to show up. Why is that?
And really, it all boils down to this one core idea. A high salary is fantastic. It's the starting line. It gives you potential. But it's just potential. The real engine, the thing that actually turns that income into lasting wealth, is discipline. Someone with a solid system will almost always end up in a better place than a high earner who's just winging it.
And that's exactly why we're calling this a life design system. This isn't about having a crystal ball or trying to time the market perfectly. It's about building a robust structure, a plan that has clarity on your goals and your risk tolerance, a system that's built to handle whatever life throws at it.
So what's the first, most practical step in this whole system? It's this simple, but incredibly powerful rule: save at least 15 to 20% of your income for your long-term goals. Now, this isn't some crazy impossible number. It's designed to be achievable. But if you do this consistently over a couple of decades, the power of compounding pretty much guarantees you'll reach financial independence. It's that effective.
Okay, so you're saving that money. Great. Now, where does it actually go? This brings us to the blueprint itself. And here's a critical insight, maybe one of the most important takeaways today. How you split up your money across different buckets is way more important for your long-term stability than the specific investments you pick. Let's break down what that structure looks like. This table lays it all out perfectly. I want you to think of your financial life in these 4 distinct buckets. First, you've got your emergency fund. This is your firewall, your sleep-at-night money that keeps you from making panicked decisions. Second is your long-term wealth bucket for things like retirement. This is where you put your growth assets. Third, you've got a stability layer with safer stuff to smooth out the ride. And finally, bucket number 4, your home.
Now, the blueprint has some really clear advice on real estate. The idea is to own a home for comfort, for stability. It's the emotional anchor of your plan. But, and this is a big but, be very, very careful about treating property as your main engine for growth. If you look at the data over the long term, equities have just compounded way more effectively.
So you've got the perfect blueprint. You're saving your 20%, you've got your buckets all set up. You should be golden, right? Well, this is where the real work begins.
Because the single biggest threat to your financial plan isn't a recession or a market crash, it's your own brain. Our emotions are hardwired to overpower our logic.
And I'm sure these look familiar. These are the usual suspects, right? That pit in your stomach when the market is dropping like a rock. That FOMO and greed you feel when it seems like everyone else is getting rich overnight. And maybe worst of all, that soul-crushing impatience when it feels like your investments are going nowhere for years. These feelings are the termites that can eat away at the foundation of the best plan in the world. So, how do we fight back? We need behavioral anchors, things to hold on to when the emotional storm hits. The very first one is to remember that the daily up and down price of a stock is mostly just noise. It doesn't reflect the actual health of the business you own a piece of. Price volatility and business volatility are two totally different things.
Anchor number 2 is a classic for a reason. It is absolutely true. Your long-term success is going to be determined by the decades you spend invested, not the handful of days you spend trying to perfectly predict the top or bottom. Nobody gets timing right consistently. Nobody. This one is a huge mindset shift. Once your system is in place, your only job is to stay put. That's it. Some of the greatest companies in the history of the world have seen their stock prices get cut in half on their way to creating unbelievable wealth. Corrections are just part of the deal. Your reaction to them is what determines your final outcome.
This anchor is so important for managing your expectations. Honestly, the first 5, maybe even 10 years of investing can feel, well, pretty boring. It doesn't feel like much is happening. That's because the magic of compounding is totally backloaded. The really explosive, life-altering growth happens in that second decade and beyond. You have to get through the quiet years to witness the miracle.
And finally, you have to understand this. Being calm isn't just a nice feeling in investing. It is a legitimate superpower. The ability to just sit patiently and let your plan do its work while everyone else is running around screaming is what separates the good results from the truly great ones. Okay, so we've got the blueprint and we've got the psychology. Now, let's make it real. It's time to build a personal system that actually automates your discipline. A system designed to protect you from your own worst emotional instincts.
And it really just comes down to these 5 key steps. 1. Figure out what your absolute non-negotiables are. 2. Put realistic timelines on those goals. 3. Automate everything so you don't have to think about it. 4. And this one is huge. Aggressively fight against lifestyle inflation. And 5. Write it all down. A simple 1-page investment policy is like your personal constitution when things get chaotic.
And this chart illustrates perfectly why that lifestyle inflation point is so dangerous. Just look at the 2 scenarios. You get a pay raise. The consumption-first person sees their spending go up almost as much as their income, with just a tiny bit more going to savings. But the savings-first person, they automatically direct the lion's share of that new money toward their future. Over a 30-year career, that single choice creates an absolutely massive gap in their final wealth.
And that brings us to the most important question of all. Why are we even doing this? The spreadsheets, the discipline, the patience, what's the point? It's not about just getting the biggest number in your account. The real goal is something much, much deeper.
This is the true definition of wealth. It isn't a number, it's a tool. It's the tool that buys you the freedom to control your own time. It's what gives you the power to walk away from a toxic job, the ability to care for your family without financial stress, and to have the simple, profound dignity of making your own choices in life.
So, what's the ultimate secret to all this? It's kind of funny, actually. After you've done the hard work of designing your system, your biggest job is to just get out of the way. Success doesn't come from constant tinkering or making brilliant moves. It comes from letting a good, simple system do its work over a very long time with as little interference from you as possible.
So there you have it, the blueprint for designing a financial life that builds true freedom. We've covered the principles, the structure, and the psychology. The only question left is the one you see on the screen. You have the blueprint. What will you build?